Welcome to the Fitness Plus Technology Podcast for club owners, operators, and fitness professionals. Each week, host Bryan O'Rourke brings you an expert interview with a global influencer at the crossroads of fitness and technology. You gain the insights, tools, and inspiration you need to stay connected to the pulse for what matters most for your business in the age of exponential technologies.
Hello, listeners. This is Bryan O'Rourke, your host, and welcome to the podcast. It is the holidays, and as you know, we're coming up on 2021, hopefully a brighter chapter in our industry space. Thank you for listening. Today, in the advent of trends, I wanted to share my interview that I just had conducted on December 16th with Rohit Kulkarni, who is a corporate finance and strategy head for MKM Partners. And MKM works in investments. They have a research team, and he heads up their capital markets and head of MKM Ventures. So for their clients, they were doing a deep dive with me on the markets, what I see as a result of COVID, but other broader questions, including the impact of big tech and other dynamics. So this was an interview for their private clients. So I'm hoping that you will enjoy it. And if I can do anything for you in the new year or anytime, please reach out to me at bryanko'rourke@gmail.com. Listen, I'm wishing everyone a better 2021. I hope you have some peace and safety over the holidays, as many of our friends are on lockdowns around the world. This too will hopefully pass soon as the vaccine becomes available. And again, I wish you all the best. I hope you enjoy this interview with Rohit.
Hello, everyone. Thanks for joining. My name is Rohit Kulkarni. I'm the Internet Analyst here at MKM Partners as part of our Road Ahead 2021 and Forget 2020 conference series. Anyway, jokes apart, I'm really happy to welcome Bryan O'Rourke to this discussion on working out at home, digital health as we navigate the pandemic and try to shed the pandemic pounds in 2021. I think Bryan O'Rourke is probably one of the leading global experts at the intersection of fitness and tech and the trends underlying health clubs and fitness industry. He sits on the board of IHRSA, which I think is the leading global trade organization for health clubs. He's currently the CEO and chairman of a PE firm, private equity firm, Vedere Ventures. He's doing where he does investments in this space. I'll flip it over to Bryan quickly, and maybe you give a quick intro, and then we'll jump into Q&A. In case people have questions, type them up in the chat box at the bottom right. I'll read them. This is as informal as we want to be, and I've relied on Bryan just to pick his brains on what's happening with Peloton, Apple Fitness, Google Fitbit, M&A like Lululemon and Mirror, many things like that. There are a lot of things brewing. So
there are.
I guess, Bryan, quick intro, and then we'll jump into Q&A. Thanks for doing this with us again.
Oh, welcome everybody. Rohit, thank you. It's been nice to chat with you over the prior months and keep in touch on these significant trends. So you had mentioned my background. People can follow me at Bryan K. O'Rourke. It's Bryan with a Y on most social networks. And if you want to read my materials that examine these things, I have a podcast, Fitness Plus Technology Podcast, available on all major platforms, or connect with me on LinkedIn. And you can see my readings. I've been in the space for, over almost 30 years, 20 some years on the bricks and mortar side and on the technology side. So it's a pleasure. So thank you for the opportunity to chat.
Awesome, cool. Let's just, in terms of table stakes, how would you characterize, Bryan, the state of the fitness industry, state of the intersection of fitness and tech pre-pandemic? And were there parts of the industry that you thought were growing more quickly than the others?
Yeah, so in bricks and mortar, of course, value players like Planet Fitness, which is now the largest brand in the world with 14 million members, McFit in Europe, and others on the budget end have proliferated in the past decade. Of course, along with boutique and higher end brands like Equinox, Soul, Lifetime, and others. So, as you see with other consumer markets and bricks and mortar, there's been a clear bifurcation trend that has continued for some time in bricks and mortar. Now, the digital end, and that's been growing for a lot of reasons in the macro side that you know, people interested in their health and, and taking care of themselves. Now, the digital side, the growth there has been more pronounced, of course. Digital users as of 2019, and we're just talking about apps and trackers. We're not talking about smartwatches. We're over about 1.2 billion users. And of course, that number is going to be much higher at the end of this year. Yep. And that compares to about 185 million health club gym users around the world. So, you've seen this real shift to digital, as you've seen with all industries. That's where a lot of growth has come. And just like with retail, you see this opportunity for the deft integration of both the digital and physical experience into, singular platform experiences. So platform as an enterprise or a business model. And we see those out there now with the likes of Apple and others. And so the other thing I would note is that fitness as an industry space, again, like a lot of industries, is really part of a great arena, as Rita McGrath would say, our friend from Columbia. Fitness is really integrating more and more into an overall health and lifestyle dynamic. So, you've seen the increase of interest in sleep, interest in meditation, nutrition, lifestyle, fitness and wellness, travel, other kind of sectors that are part of this larger pie that fitness sits in. So that's become more pronounced as well, as is the opportunity for integration into health and primary prevention and chronic disease management. So a lot's been going on in the space. The macro trends there are hugely robust.
Okay. As in, so just to kind of draw a final point, so you think the secular trends in the pandemic with various different themes that you just called out, which ones are you, as in stating the obvious, fewer people are going to the gyms, probably there are going to be a bunch of bankruptcies if there haven't been. Yeah. And at-home fitness is growing much rapidly. Apart from these two obvious trends, which ones would you think, looking back 12 months, have been more surprising, both on the positive and the negative side?
So what surprised me is some of the valuations of some of these firms that have come out. I mean, while the macro trends are there to say there's going to be a shift in demand, Peloton's valuation is just, in my opinion, not sustainable. I think from a technical perspective, there's probably some more room to run there, maybe. I'm not a technician, but I would imagine reading what I do in the charts, that's potential. But, the valuations surprised me because Peloton is just not a $38 billion company when you start doing the math. So, I appreciate certain buyers' interest in the story of growth, but some of these things have just become a little absurd. So that's my opinion. And then the other thing that kind of surprised me is, the rate of acceleration. I mean, I knew that COVID, like it has with all trends, has accelerated, things that were already, Rohit, in play, right? But I probably didn't anticipate that level of acceleration as being as high as it came to be. We just had a survey that we sponsored come out from Club Intel, showing that, 40% of gym members are working out at home using, technologies to do that. So it's almost half of the market. And so, I anticipated that to continue to go up. I guess at the time, looking back, you kind of understand it, but at the time it was more than I had anticipated it would be.
So two things there. One quick clarification. What was the survey? Who published that?
Club Intel,
Club Intel.
CLUB
Okay,
Intel. Yeah,
I'll
they
look it up.
just published it today, and it was a survey of gyms around the United States and members, and getting some statistics on what has happened. The survey was conducted in November of this year, the end of November.
I see. Okay, and then zooming it into Peloton, as in again, the company has got the perfect kind of tailwind, if you will,
Right.
as in terms of having a product, having a value proposition,
Right.
in the middle of the pandemic, and having a story to tell.
Yeah.
So, why do you think that the company's valuation is as high, as in terms of, leave aside the financials and fundamentals, but from a pure product positioning and a competitive standpoint, where do you shake out at?
Well, I think it's just what you see sometimes with trends and shares and people right now. I mean, I think that these are more technical questions than they are value questions. It depends on, what your investment thesis is and how people are trying to take advantage of various dynamics in the marketplace. Of course, I've read their S1, look at their TAM analysis, and just me, but I think they're just highly overvalued firm right now for a lot of reasons, and I think that also applies to a few other dynamics that we've seen. I think it's sometimes the market gets a little over its skis when it comes to things, and people have fear of missing out, kind of FOMO dynamics. When you look at Lululemon's acquisition of Mirror at $500 million. I think back on Under Armour and their classic and crippling mistake, only 5 years ago in acquiring a bunch of digital assets, and they completely, missed the mark when they sold these off at a huge discount. So sometimes I think, in the case of a Lulu, they have a tremendous growth story, so they've got to keep that story going, and. In a market where you have frothy valuations, good for those folks that have benefited from it. But I think it's a cautionary tale outside of the overall trends, because I think Peloton is a play personally that could be a death by 1,000 cuts because of all the competitive entry that's out there, providing alternatives that are less expensive and multidimensional in their in the way that they serve customers. So. But great. I think Peloton's still a great company. Nothing against what they've done. I think, I think they're a valuable company, but I just don't think they're worth the price that they're extracting right now.
Okay. In terms of kind of competitive or product positioning, as in which other companies do you think are doing as good or a better job as compared to Peloton right now?
Well, in the public markets, Nautilus has had a huge run since the beginning of the year. They've appreciated more significantly than Peloton. Their stock price is up almost 17 times from its lows, I think, in January, pre-pandemic. Now, they're not as big of a growth story, and their price of shares has declined by 30% since their high, I believe, in November. But, they were in the commercial business as well. They sold off their commercial line of Octane recently, which they mistakenly purchased for over $100 million several years back. They took a loss on that. But there are a lot of dynamics for Nautilus that make it an interesting value play, at about 500 some million. I like them. Privately, I like Whoop a lot, WHOOP. They have a huge following. Their device, Rohit does some interesting things in how it, uses heart rate to evaluate stress, sleep, and activity. I think they are a potential acquisition target. I also like Noom a lot, based out of New York. The weight loss management platform. I think it has around 50 million users right now. It's a very powerful platform. It has been approved by the CDC in the United States. It's a very interesting platform in how it uses behavioral modification and other collection of data to engage people in activity. I think that is a realm where we're going to see a lot of development in the coming years to address both the primary prevention and chronic disease aspect and deploy AI and other big data tools as part of that delivery system. But I love the Noon platform. I also like Calm a lot. I think being the number one player in that sector, it's not in fitness per se, but I think wellness, meditation is a huge market with a big reach. I really like that company. Planet, Planet I think is fitness. I think their stock's a little high right now, but I'd be a buyer in the 60 share range because look, there's going to be a have and have nots dynamic at play probably in about 6 to 9 months where the survivors that are well positioned in the market and have reach are going to benefit from a lot of facilities in the United States that are going to permanently close. So you're going to have a lot of people looking for membership, and Planet's very well positioned to take advantage of that. So those are some of the ones I would keep an eye on.
Okay. In terms of other kind of companies that I have tracked with this connected fitness product category, I think Zwift is one that raised a lot of money.
Correct.
Icon Fitness, Tonal, Strava, all these companies have raised more than maybe a couple $100 million in the last 12 months.
Right.
Kind of tangentially doing things that probably Peloton is trying to do in terms of at-home connected fitness product with instructors that are live or asynchronous recorded classes.
Correct.
So what's your kind of, so just to throw out the names again, Zwift, Icon, Tonal, Strava. I feel SoulCycle is also doing something in that realm. So any particular of these 3 or 5, any particular ones that could give Peloton a run for their money? Or are they too small or have low tech right now?
Well, I think Strava is a very interesting one. It's been around quite a long time. It has a very, very enthusiastic community. More on the athletic side, as you know, a little more sports oriented than Peloton, I'd say. Zwift as well. Zwift is a very interesting platform. What it does more centric to cycling and how those rides involve more of a deeper interactive environment. In that case, you use, as you know, your own road bike. I think that's a fantastic company. I like both of those a great deal. I think they have some niche aspects to them that are very differentiated from what Peloton does. And Peloton shifts more female. It's a little more female shift, etc. Those users are not going to be necessarily the same types of users as Zwift or Strava. And in the case of Zwift, you're dealing with people that are both going on the road physically and cycling and then doing it at home as well. So I think they're a fantastic company, and of course at a much more manageable valuation. So they're not public yet, but I think that that's a very good company to keep an eye on.
Okay. Another kind of from the investment community, one kind of moat, if you will, that people wonder on at-home fitness is you're staying at home, you're alone, but you need a social feeling when you're working out. And that's something that's a problem that many other companies prior to Peloton couldn't solve. And Peloton over the last 12 months, 18 months, there is this overused cliche, network effect of social and community-based working out, although physically you are alone at home. So how much is that valuable? As in from a personally speaking, as in if I'm working out, I would rather not be bothered by other people or other people who are shouting in my ear and things like that. But again, I think that's a very valuable value proposition, as in terms of creating stickiness and more a kind of cult-like feeling for the platform. So again, what do you think of this? Are there other elements that these kind of new tech players are trying to solve for getting that social or community feeling?
Yeah, well, Zwift does that in different ways, and of course, every brand's going to have a unique aspect of their experience, and that is some of the secret sauce of Peloton, no doubt, is the quality of their instructor base and what they do with their personalities. It's really as much entertainment as it is anything, and they do a great job of it, and you have to give them a lot of kudos for that. And I think other platforms will do it in different ways. Some of them will duplicate, like Echelon, or attempt to duplicate the Peloton dynamic. Others will do it with rowers and try to do those things. But certainly that's the secret sauce from Peloton. In the case of Zwift, in the racing components that they do, it's a different experience in many respects, but certainly that appeals to the the users that enjoy that platform. And similarly with with Apple's product, some of these platforms will provide a more automated experience and connect kind of in different ways. Others will be more apparent in a true group fitness dynamic like Peloton. I think we're going to see a series of all kinds of different dynamics. One of our companies, Motosumo out of Denmark, does it very uniquely in how they do group rides using just smartphone technologies and that connectivity. And it's done in a different way, but it's very effective in its stickiness. So I think you're going to see all types of forms of that kind of network effect in a place. Even Noom has a network effect because users are assigned to groups to, converse with each other about their progress, and you have sharing and other, capabilities within it to make it sticky. So I think that's going to be one of the dynamics. And then still, there are a lot of people that use apps that don't have any community aspect because they don't want to be bothered, right? And those take all kind of different, whether it's Lightspeed's V, coach who is coaching you through your workouts one-on-one, to others. So, listen, I think it's all about, customer choice. And I think there are going to be a lot of different markets for different users.
Mm-hmm. Okay.
Yeah.
As in tangential question on, you mentioned some copycats and likes like that. There have been some intellectual property lawsuits between Peloton and its peers, both in both directions. Echelon and I believe SoulCycle. There was one more other that they settled earlier this year. Any reaction? Any thoughts on that? As in, in terms of the most recent ones where SoulCycle is doing back Peloton and likes like that. What's your industry? When you wear your industry experience hat, what's going on over there?
Well, I work a little bit in IP, but certainly today the marketplace of IP and the disputes that can arise through technology claims are getting more and more challenging every day. I think, personally, I believe some of these efforts at litigation are designed from a strategic perspective to perhaps investigate opportunity. I don't know enough of the technical details, Rohit, to give you reliable insight there. But, there have been several, as you know, in the past litigation matters with Peloton, including the licensure of music. So anytime you have a company that becomes worth $38 billion in a course of short order, you're going to have a lot of people show up and lay their claim to infringement on a host of different issues. And so it doesn't surprise me in the least.
Okay. Kind of switching gears a little bit in terms of big tech. We talked about a little bit on Apple, as in longer term. Where do you think the strategy of kind of various different big tech companies will look like? As in, is there now at the end of the day the gravitational pull that's just going to take away the oxygen from other best of breed players, or is this just one more kind of experiment at big tech companies, in your opinion?
So with Apple, it's pretty clear what this is because Tim Cook's been talking about it for several years. He's made no secret about the fact that the legacy for the brand he sees as being Apple having made a significant impact on the health of the world. He's been saying this in interviews going back 3.5 years. And it makes sense. Recently Scott Galloway had done some presentations on this. I mean, when you see the why behind Apple's strategy, it's a rumble strategy in general with recurring revenue. It's why their PE multiple has increased so much in the past couple of years. But more than that, to reach their targets of doubling revenue by 2025, there's really only one area of industry that they can attack to do that, and that is health. They need to grow top line revenue by $250 billion in the next, probably 28, 36 months. So health is where they're going to do that. And fitness is a subset, as I was talking earlier. It's certainly its own core market, but increasingly, when you look at it, just in the health club side alone, less than 20% of the U.S. population are members of health clubs. It's a very small market. And out of that market, there's a smaller group that really use those services at a pretty high frequency. So then you look at the opportunity of primary prevention, knowing that chronic illness, about 75% of chronic illness relates to lifestyle. And then also that Apple is looking at a lifetime relationship with their clients and customers, because that creates a lot more value in the lifetime value of their brand. And so health is where that's going to happen. And it's no different than, and of course about all their efforts in the medical records side and other things that Apple's up to. Anyone can just go to their website and look at their health component and see everything they're doing. So, I think, by the way, Apple's fitness subscription, I think it's going to have about 10 million users pretty easily within the first 12 months. And I think that's going to be probably a low shot number. But then you look at Google. I mean, they bid on Fitbit for a reason. Of course, there's a data component to it. But Facebook was right behind them in bidding for Fitbit. You see what Amazon has done with Halo, their new product, and what they're doing in both pharmacy and other aspects of health. So I think in big tech, it just makes sense in looking at it that this is where those companies need to go to keep their growth moving at the level that they need to move it. Now, does that mean that they are a Peloton killer? No, I think that there are going to be plenty of niche brands that serve, certain customers in a certain way. And I've already opined on valuation around that, so I won't beat a dead horse. I mean, you can buy Apple at, about 38 times earnings, and Peloton today is well over 1,000 times earnings. So, but neither here nor there.
Tech growth investors don't care about earnings.
Yeah, I know they don't. And I respect that. It is a growth story, but still. But anyway, there are going to be plenty of different niches that play in that, in that sandbox. But when you talk about network effects, certainly with 1.5 billion devices, Apple's got a hell of a lot more leverage when it comes to network effects than some of these smaller players. And a lot of those smaller players are going to opt into their network too, through different partnerships. We've seen even the commercial space. Apple has, Gym Kit to try to interface with treadmills and equipment. They have a gym reward program they've been, testing so that brands can co-opt into their network. Maybe they're a little, need to be a little careful and cautious, a la Amazon with books, Borders books. But, I think there's going to be a lot of opportunity for big tech in the coming years here.
Okay. We are running on time. So I received a couple emails. One of them was just, do you have any? What was your reaction on Mirror and Lululemon deal, and what would not surprise you? As in, if you just do Google searches on Peloton, Apple, there are like media articles published on why or why not Apple should buy Peloton. And likes like that. So two questions.
Two questions. Yep. Lulu. Lulu, I think, it's understandable what Lulu's doing. I mean, it's kind of like what Nike was doing with the Fuel Band years ago. It's like what Under Armour tried to do with their acquisitions. And listen, Lulu's a great company. They got great management. I hope they're highly successful with Mirror, and maybe they can be. But I think they overpaid for it. I think that they, I hope I'm wrong. But I see it as another, kind of blunder, but it's done for a reason. They want to keep their growth story going because they're a very high value company. As far as Apple, look, Apple made the gangster move of the 20th century when they went into retail. So nothing would shock me about what Apple might do. Now, would I think they'd buy Peloton at this value? I don't think so, but you never know. I mean, it wouldn't shock me to see an Apple even acquire a bricks and mortar, the right kind of bricks and mortar brand if it made sense. I mean, they're now arguably the most successful retailer in the world. Now, do I think that's going to happen? No, I doubt it. But would it shock me? No, it would not shock me. Amazon buying Whole Foods would have shocked a lot of people probably 2 or 3 years ago, and it now doesn't shock anybody. So who knows?
Okay, on to 2021 predictions, as in, I guess, reopening, vaccinations 6 months from today, as in, what happens to the gyms that are still around? Like, are gyms doing something special to help gym goers be less worried about going back to the gym? Is there something that you have come across?
There's a lot of research on this, and it's really disappointing. Sitting on the URSA board, watching some of the public misinformation, and kudos to Governor Cuomo recently, who came out and acknowledged a week ago that the numbers confirm that fitness facilities are not spreaders. They had been lumped into bars and restaurants, and the research just doesn't support it. We've put out the International Health Rack and Sports Club Association. We've recently put out a Global Active and Safe pledge, and a lot of brands like Planet and others are going above and beyond in sanitizing, creating protocols. And there's a lot of research that shows that gyms and fitness centers just are not a breeding ground for spreading the virus, and the numbers are what they are. From a market perspective, though, the fact that you're going to have the number of closures you are, both in the U.S., Europe, and other markets, primarily U.S. and Europe, there's going to be a huge opportunity for the brands that I've mentioned before that make it through. Mm-hmm. And so, I can see earnings up significantly at these businesses in the next 6 to 9 months as orphan members don't know where to go. At the same time, you're going to see brands like Equinox and others continue their foray into omni-channel, offering a blend of digital and physical fitness experiences, just like you've seen retail do and other brands do, that deft integration of customer experience. And you're going to continue to see the shift to pure digital. And the middle market, like with all other industries, is going to continue to get harmed. So there's going to be a lot of consolidation, some brands that fail, some that recapitalize. The underlying macro trends, though, are all positive. We continue to see the industry gain tremendous traction in the coming years because of those underlying macros. And there'll be a lot of money to be made here in the next year and change when things get back to normal.
Okay, cool. And one last one is on, I just received an email on, there was this trend of boutique classes, like non-biking, non-running, non-traditional gym classes. That was probably the big bright spot pre-pandemic. Yeah. Obviously, a lot of companies like Orange Theory, maybe ClassPass, a few of those are hurting a little bit. Is there a bounce back there, or is this now a permanent shift away from those kind of boutique CrossFit / Orange Theory / because that was, if I had to guess, there were people willing to pay $30 to go there once, maybe 5 times a month, something like that, as compared to paying $50 for a digital membership.
Yeah, and that's a big trend. But there was in a lot of markets there was a huge oversupply of those product offerings. You could just look at Manhattan itself, and very trendy. SoulCycle was one of the leaders, one of the most profitable, brands from a unit economic perspective when it, was back a few years ago. But, a number of these boutiques have been grown via franchise models, and I personally question their financial viability. I think the level of competition, mostly in metropolitan markets, has been very high. I think the unit economics originally were much more appealing than they are now, as investment has risen in these things and competition has increased. So, of course, boutiques are here to stay. I think in certain brands, they will do very well. And I think in other models, maybe not so much. So, that's my feedback on that.
Okay. I have two questions, so sorry about extending your
fine.
time, Bryan.
Fine.
Quick ones if you can.
No problem.
What percent of gyms do you expect to close due to COVID? As in, have you come across good data or through your industry conversations?
Yeah, Club Intel's recent report addresses some of this. In current day of November 30, IHRSA has done a report on this. You can go to the IHRSA website, ihrsa.org. I estimate in the U.S. A third of facilities will permanently close, through the pandemic. Some people might argue a little bit more. Some people might argue a little bit less. But that's my expectation. And that's why previously I had mentioned that the survivors are going to do very well because people are going to want to get out. They're going to want to have their physical experiences in clubs. And I think there may be some pricing power in certain markets, which has not existed for clubs in some time, for certain concepts. And then you have Planet, who, the largest chain in the world, they're going to continue to grow. So those brands that have the staying power, I think are going to do very well.
Okay. One last question.
Yeah, sure.
I'm just going to read out. I was wondering if Bryan can share his view about big tech entering the actual healthcare system, with platform competing with Teladoc and AMWL, as in health insurance as such.
Yeah.
Looking at what is happening in Europe, the US health system looks very expensive and inefficient. Maybe a large outsider can actually offer something better.
Yeah, and that's what Apple's doing right now. They're trying to do that. I think they are in 13 health systems and others. I mean, you've seen Amazon in pharma, Amazon doing things there. I think that is probably one of the mother of all business opportunities that exists today. Of course, the U.S. from a policy perspective and the delivery system, which is highly inefficient, fragmented. But more than that, the underlying dynamic, which is primary prevention, even, preventing chronic illness, but even managing it. So, I think big tech is looking at that. As I mentioned before, you can even Google my deck on SlideShare on Apple and health, which I recently did, and what they're doing and why. It goes through this in detail. And as you point out, it's not just them. Teladoc is a great company. I think they're going to be more like that because all you have to do is think about it from a user perspective. Do you know how hard it is to get an appointment and see a physician? I mean, it is absolutely absurd. So there is so much opportunity in the realm of the United States and in Europe to make this happen. Now, as far as insurance goes, that's a whole other conversation. I am more of personally, I am not as high on insurance because I think that in the United States, insurance companies are really middlemen between buyers and sellers, and they don't really create value. And there's a lot behind that I think has to do with marketing more than it does truly helping the overall system on cost, because insurers don't really have an incentive economically to drive down cost, in my opinion. So that's a controversial position. But we could spend a lot of time on that. So I don't want to be trite or cavalier in my commentary. So,
yeah, as in, I did my 3 COVID tests with Google's Verily, Europe and San Francisco. As in, all 3 of them, very simple drive up. I tried to call Stanford Healthcare. I tried to call hospitals. They were like, "Oh, we don't have availability." And I drive up to Google's big tent here, and one of the best, kind of cleanest thing that, and they are solving debt also as a side project. So jokes apart, as in Google is doing moonshots that nobody else is probably even thinking of.
It's a mother of all business opportunities. I mean, big tech, God bless them. I hope they figure this out because, boy, I'm telling you, there's some money to be made there.
Okay. Awesome. Cool. Again, I'm sorry we ran over, but thank you so much, Bryan.
Thank you.
And thank you for everyone who could join us. And I'll look up the reports that you just mentioned and happy to share with people who may be looking for them.
Yeah.
Again, I hope you have a happy and healthy holidays to you and your family.
Hey, the same to everybody, Rohit. And please, if you need to reach out, you can find me on LinkedIn. Happy to talk to anybody or be of help. Rohit, I appreciate it. Enjoy your holiday. Good to see you again.
Take care. Bye-bye.
Take care.
Thanks.
Bye. Hello, listeners. This is Bryan O'Rourke, and thanks so much for listening to the Fitness Plus Technology Podcast. The podcast is made possible by the Fitness Industry Technology Council, a consortium of global brands working together to enhance the adoption of technologies in the fitness space. Our company, Videri Ventures, which is invested in Vertimax, Montezuma, Gold's Gym, Houston, Texas, and Fitness 24/7 Thailand, also underwrites the podcast, along with our service companies, Integris Advisors, Moon Mission Media, and others. Please feel free to share this podcast with your colleagues. And if I can be of any assistance to you, don't hesitate to reach out, bryanko'rourke@gmail.com, or find me on any of the major social networks. Have a great day, and thanks for listening.